The Fed just held rates steady at 4.25, 4.50%. Also, housing has never been this unaffordable, but perhaps you still don't see the relationship between these two things so clearly. So, in today's video, I'll break down why the Fed held rates steady, how this decision impacts credit, consumption, and the broader economy, and most importantly, how you should position your money now, because understanding what's behind the Fed's pause is critical, not to place blame, but to clearly see your next move. If you want to stay ahead, subscribe and comment below to join our community. Well, first of all, what's happening in the housing market? Take a look at this chart from Bloomberg, built with data from the National Association of Realtors. This is the Home Buyer Affordability Index, and it's just cratered to 87.8, the lowest reading in recorded history. But what does that mean in real terms? It means the average American family cannot actually afford the median-priced home. A reading below 100 signals that typical household income doesn't stretch far enough under current mortgage rates. The last time affordability edged close to that line was in the late 1980s, and today, it's even worse. With mortgage rates hovering around 6.75%, housing costs have nearly doubled over the past 2 years. Here's a practical example. A $400,000 mortgage at 3% in 2021 would translate to roughly $1,686 per month. Today, that same mortgage costs over $2,594 per month. That's almost $1,000 more every month, interest alone. This dynamic is creating a market gridlock. Homeowners locked into lower rate loans stay put. Prospective buyers are priced out. That lock-in effect is choking housing turnover and suppressing inventory. On top of that, the United States is grappling with a severe housing shortage. Research shows we're currently millions of units short, partly due to decades of exclusionary zoning and underbuilding in high-growth metros. That artificial scarcity keeps prices elevated, even as buyers vanish. And there's another layer. High tariffs and tighter immigration policies are squeezing labor markets, pushing up construction costs and further limiting supply. That combination of weak supply and rising input costs is keeping affordability stuck at historic lows, even as demand falters. So the result is brutal. High rates, inflated prices, low turnover, and limited new supply all feed into a vicious cycle where homes stay unaffordable. Yet the Fed has chosen to hold rates steady. Why? Let's unpack that next. First motive is inflation just won't go away. Core inflation, which excludes food and energy prices, is still stubbornly high at about 2.7%. On top of that, recent tariffs are causing extra uncertainty, potentially driving up prices even more. The Fed needs more clarity before making any moves. Second, the job market surprised everyone again. While a few months ago it seemed unemployment was climbing, June 2025's data came out and unemployment actually dropped slightly from 4.2% down to 4.1%. This is critical. It means the economy still feels strong enough in the Fed's eyes to handle higher rates without collapsing. There's also a big political angle here. President Trump has been very vocal about wanting immediate rate cuts, but the Fed is careful about showing independence, making sure their decisions are based on economic data, not political pressure. Now, understanding why the Fed paused is just step one. The real question, how do you position yourself from here? Since you probably can't buy a house now because it's too expensive, let's talk about investments. And who knows, in the future, by investing well, you might achieve your house or any other financial dream. So, well, let's be clear, the Fed didn't cut rates yet, but it's paving the way. You sure can be hopeful. The CME FedWatch tool shows a 60% probability of a first cut in September. Goldman Sachs is now projecting 0.25 PP cuts this year, September, October, and December, bringing the federal funds rate down to around 3.0, 3.25% by early 2026. And with this information, you can do a lot of things. The first thing is talking about market. Every time real interest rates drop by 0.50, the price to earnings multiple of the S&P 500 tends to increase by about 3%, according to a model by Goldman Sachs. That's because when interest rates fall, the discount rate used to calculate the present value of future earnings also falls, making future profits more valuable today. And no sector benefits more from that than technology and growth stocks, whose valuations depend heavily on earnings projected 5, 10, even 15 years into the future. Now here's the kicker. If the Fed follows through with the 3 0.25 cuts that Goldman projects for 2025, starting in September, that adds up to a 0.75 reduction in the federal funds rate and potentially a similar move in real rates. That means we're looking at around 4.5% to 5% upside in the S&P 500 just from multiple expansion alone. And because big tech makes up such a massive share of the index, over 30% of the S&P 500 and more than 50% of the NASDAQ, that effect gets even more concentrated. This isn't theoretical. Investors have already started to price this in. That's why the NASDAQ hit all-time highs in July, even before a single rate cut was announced. Markets move ahead of the Fed, not after. So if you're waiting for Powell to actually cut before moving your money, you're probably already late. So what does that mean in practice? It means that in this kind of environment, being positioned early is everything. If you're sitting on cash waiting for the Fed to make it official, you'll probably be buying after the move already happened. The smart money doesn't wait for confirmation. It moves when the probabilities shift. Let's take treasuries as another real-world example. Right now, 10-year treasury yields, if the Fed cuts rates as expected, those yields could fall to around 4.20% or lower by the end of the year. Doesn't sound like a big drop? Here's the key. When yields fall, bond prices go up. And for longer duration bonds, this price appreciation can be significant. This is the essence of mark-to-market in fixed income. Let's say you buy a 10-year treasury today at a 4.45% yield. If yields fall to 4% over the next few months, the bond you're holding instantly becomes more valuable, even though the coupon payments didn't change. You could sell it for a premium before maturity, pocketing capital gains on top of the interest. This is why institutional investors pile into bonds before the rate cuts, not after. In practice, that means your $1,000 investment could be worth approximately $1,038, giving you a $38.30 capital gain, and that's in just a few months. And it's not just treasuries. Corporate bonds, municipal bonds, mortgage-backed securities, they all get repriced in the same way. If you know rates are heading lower, locking in current yields today gives you both income now and potential upside later, especially in longer duration bonds where the sensitivity to interest rates, what we call duration risk, becomes a source of opportunity, not danger. So what's the play? If you're conservative, look at treasuries or investment-grade corporate bonds with longer duration. Lock in high yields now and benefit from price gains if rates drop. If you're aggressive, consider bond ETFs with high duration exposure or leveraged fixed income funds that can amplify the upside from rate cuts. And if you're in cash, realize that the window for high-yielding, risk-free returns might be closing. Parking everything in short-term instruments right now could cost you more than it protects. This is how the market works. It doesn't reward people for reacting. It rewards people who prepare. That's it, cousins. Stay invested.